Hello, everyone. Good morning and welcome to the 2026 COL Market Outlook. I'm Charles and I'll be your host and moderator for today. The PSEI has had an interesting last few months. Since the middle of 2025, when it was largely stuck in a sideways pattern, the market seemingly went from bad to worse following the flood control corruption allegations and the slowdown of GDP and corporate earnings growth. These led to the market briefly falling below the 5,600 level in mid-November, a level not seen since 2020. Interestingly enough, the local market has since recovered, rallying by over 13% from the lows. This is despite investor sentiment remaining weak. So is the worst over? Are we in position for a better year, or will these issues linger for most of 2026? Most importantly, what are the risks and opportunities to watch out for the year? These are the questions that we hope to shed some light on this session. For today's program, we'll first invite our speakers to share their views. This would be followed by a discussion on your most requested stocks. Then finally, a Q&A segment where we'll answer both your advanced questions as well as the live questions that we'll be getting today. With this, we invite you to type in your questions through the Zoom Q&A tab. Okay, so without further ado, let us now go to our first expert for today. To share her fundamental views on the market, let us welcome COL's Chief Equity Strategist, April Tan.
Hi, good morning, everyone, and thank you for joining us for our 2026 Market Outlook. So, today I'd be glad to share my presentation. Hold on. Okay, so I'm trying to share my presentation, ladies. Are you guys gonna do it for me?
Can we try again, April?
Okay, I'll just try again. Let me just. Okay, can you see my slides?
Yes, we can see it.
Okay, so let me begin by sharing with you that I understand why it's easier to be bearish rather than to be bullish right now, because there really are a lot of challenges facing the Philippine economy and the stock market. First, we have the weak global economic outlook. And in December, surprisingly, we did see more negative news than positive news, even though the market was recovering. And then, of course, we know about the corruption scandal that is hurting government spending growth. And finally, there are headwinds globally that could lead to contagion risk. Okay, so briefly, the economic outlook is not so good for 2026. For example, the world GDP growth is expected to slow further to 3.1%. And if you focus on ASEAN 5, which is where we belong, it's expected to slow down to 4.1%. For the Philippines, I mean, they say 5.6%, but I think this is, of course, on the high side. So these are economic projections of the IMF. And the reasons for this is because, first of all, remember last year, the major event was the Trump tariffs, which were implemented starting in April. Although the Trump tariffs or the final tariffs are not as bad as what Trump disclosed in April during Liberation Day, nevertheless, they're still significantly higher than the pre-Trump era tariffs. So this year, or in 2025, we had some benefit of front running of the tariffs, remember. So, for example, if you're an exporter, you would have had more export orders um, before the actual tariff were implemented, as people were trying to buy the products ahead of the higher tariffs. But this year we won't have that. Aside from that, you have businesses that are very unsure of what will happen and are kind of worried about how demand may be weak. Therefore, they are holding back on expansion plans. So that would hurt investment spending. And if you look at the foreign direct investments actually in the Philippines, for the first 9 months of the year, you actually see FDIs down by 22.2%. Okay, and this is despite the passage of the Create More Act in 2024, which, if you had attended our Market Outlook event in 2025, something that we were really excited about because we thought that, this would finally allow investments to increase significantly. But then again, despite that, the investments never really materialized. So we're worried that 2026 might be another year where FDIs will remain weak. And then there are actually other indicators that seem to imply that. For example, the BSP does a survey every quarter um, on consumers and businesses. So the latest business survey that they did, the businesses were asked, are there plans to hire more employees? And you can see that it's kind of going down, right? And do you plan to expand your operations in the next 12 months? And you can see that it's also going down. I mean, there are a lot less companies that plan to expand their operations. And for government spending, well, of course, we know that the third quarter GDP was really kind of disappointing. And one of the reasons is um, the lower capital outlay or CapEx spending of the government, less infrastructure spending. Now, you might say that this is such a busy slide. So I just want to share with you where I get my data from to have a cheating of what GDP growth will look like for government spending. And you should focus here on so this is the national government disbursements, and focus should be here on the capital outlays. So this is like their capital expenditures. That's where the spending right now is, slowing down. So you can see in the third quarter, the spending is down 23.88%. And this is due to, the government being more careful in their disbursements. So, for example, according to the report of the DBM, they are strengthening measures to verify payment claims and actual accomplishments, including project management to minimize corruption. So in the third quarter, remember, we had a very disappointing GDP growth where, the investment spending actually went down. And this is based on not even a full quarter impact of, the scaling back of investment spending. So as of October, it's actually down by 34.6%, which is faster. That's a full month impact. So if this continues to happen, fourth quarter will probably be weak as far as GDP growth is concerned. I mean, Finance Secretary Frederick Go said the first quarter government will be, ramping up spending again. I mean, hopefully it happens. Otherwise, we will see weak GDP growth again in the first quarter. Anyway, for the unemployment rate, one of the things we are quite positive about previously is the continuous decline in the unemployment rate, as you can see here. Unfortunately, during the past few months, we are seeing it trending higher. So, for example, for the month of October and November, if you compare it on a year-on-year basis, we actually see an increase in the unemployment rate. And consumers have become more pessimistic after being quite optimistic. You can see prior to the fourth quarter, Filipino consumers have been very optimistic. But coincidentally, in the fourth quarter, they have become pessimistic, be it the current quarter, next 12 months. And the drags would be, the negative impact of corruption in the government on their sentiment. They talk about higher inflation despite inflation being low. I think this has more to do with the prices of food going up. For example, vegetable prices went up quite substantially. Um, and then their outlook, lower household income, maybe it's the weaker outlook for employment. And of course, the floods, the poor weather conditions. So you can see everything is turning pessimistic. Their expectation on economic conditions, family financial situation, family income, and it's across the board. And then the outlook for inflation, they expect it to go up. For the peso, um, sorry, they expect borrowing rates to go up, or it's going to be more difficult to borrow money, and then yeah, so higher unemployment rate. Those are the indications. So very pessimistic consumers, and in a way, it's kind of worrying because the government is counting on consumer spending to help the economy go up. Remember, in the third quarter, consumer spending actually fell below 5%. And prior to this, consumer spending, for example, in 2024, 23, was always above 5%. So a consumer spending growth of 4% is actually not good. And this is a trend that might continue for this year. And then finally, let's talk about potential external threats. Like the US market has been performing well. In general, we want that to continue. Unfortunately, the US is also facing a lot of headwinds. We're already seeing the unemployment rate in the US also going up. Um, Loan default rates are also climbing up in the US. So there are signs that the economy is weakening. Consumer sentiment there is also very weak. And then, of course, recently we're seeing more stress in the private credit market in the US. A lot of companies that borrowed in that space are also defaulting. And then there are also talks about the potential unwinding of the yen carry trade. So remember the Japanese bond yields are going up. So historically, what's been happening is that a lot of investors are borrowing money from Japan, and then they're exchanging it to US dollars because of course the Japanese yen continues to weaken. So and then the borrowing cost so cheap. Then what they do is they buy US dollar assets. But with Japanese bond rates going up, they now might be forced to, pay off these debts. And of course, as the interest rates in Japan go up, there is also a risk that the Japanese yen will become stronger. So if that happens, then if you borrowed money in Japanese yen, you are at risk of losing a lot of money. So kaya sinasabi nila there could be an unwinding of these investors who borrowed Japanese yen to buy US assets like stocks. They might sell their US stocks and then pay down their Japanese yen loans, no? And then finally, we don't know if AI stocks can continue to justify first their expensive valuations in the market. We know that the driver of the US market the past, I would say, 3 years already are these AI stocks, no? Following the launch of ChatGPT. And now we know, of course, their mga data centers, the chips, etc. So they've all been going up substantially the past 3 years. But their valuations have become expensive. So we can see, for example, the S&P 500. So this is a PE band. And you can see that right now, the S&P 500, for example, is trading at the high end of the range of its historical average PEs, no? So the major driver would be AI stocks. But now there are questions as to whether these AI stocks can continue to push the market higher because they're expensive. And aside from that, they have huge capex requirements. And right now, of course, we're seeing some tightening of liquidity conditions brought about the increasing stress on private credit. Um, and of course, the earnings have been growing rapidly for so many years. And then the profits are not catching up as fast. So we don't know whether this can continue or not. There is a risk that 2026 might be the year that the strength of the US market will come to an end and the market could face a correction. And unfortunately, if this happens, the Philippine market is vulnerable to a contagion because we always just, uh, you know, are affected by significant declines in the US market. Okay. And aside from that, I'm sure that a lot of you are noticing how the peso has been weakening recently. A weaker peso historically has not been good for Philippine stocks. Okay, but there are reasons to stay optimistic, and I'd like to highlight them in the next few slides. Okay, so first would be lower inflation and interest rates. Next would be the cheap valuations of stock, which seem to price in all the negatives already. And then next, we're seeing this rotation into emerging market stocks, which could trickle down to the Philippines. And finally, we are seeing some sectors which have improving fundamentals or bottom-up, picture. Okay, for inflation and interest rates, so inflation, although I know the latest inflation went up to 1.8, so admittedly, we won't have the benefit of the high base effect anymore. But for this year, inflation is expected to stay well within the 2 to 4% range, which is the comfort level of the BSP. And you can see how the BSP's interest rates have already gone down substantially from the peak. And this year, BSP Governor Remolona said that they may cut interest rates by one more time. Okay, so interest rates, inflation are expected to remain low for this year, which should be good for, or at least support consumer spending and investment spending. Although there are a lot of headwinds, at least the outlook on inflation and interest rates uh, will buffer the negative headwinds. Okay. And then on the valuation, so you can see while the US market is trading at the high end of its historical valuation, you can see that the PSEI, on the other hand, is trading at the low end of its valuation. So this PE band that I'm showing you today is the PE band since 2006. So this is a 20-year PE band. And the PE here was the stock market's PE during the low of the global financial crisis. So when the market hit the low of around 5.5, we actually retested the same level of valuation. And right now, although it has rallied, we're still very close. We're at 9 times PE. So the low that we hit in during the global financial crisis in 2008 was 8 times. So we're just one multiple away from that. So really very cheap valuations. And this just means that everybody's so pessimistic anyway, and everything's so cheap. So there are other indications to show that the market is cheap. For example, you can see that a lot of the property companies, consumer companies, and even the holding companies are trading at a discount to their prices as of end 2014 or more than 10 years ago, discounted. A lot of them. Okay. But that said, if you look at their earnings, they're actually up much faster. Okay. So there is this divergence or disconnect. No? And if you think about it, well, the derating is due to the abundance of threats. And yun na nga, if you look at the annual growth, totoo naman, it's not exciting, it's single digit. But nevertheless, you can see how earnings, hindi naman sila nalugi. No? They're still profitable, they're still okay. They've just gone through a rough patch and they're now trading at very, very cheap valuations. Parang it's not justifiable. And I mean, I've been hearing a lot of people talk about the Philippines is a value trap. But honestly, I beg to disagree because a lot of the stocks right now are giving high dividend yields. Um, and because they give a lot of high dividend yields, investors who have the capacity to hold on to these stocks actually, will benefit. I don't think they are value traps precisely because they provide us attractive dividends. So if you are a long-term investor, you can just hold on to them and wait until the market realizes their value. So you will be handsomely rewarded, no? So in that respect, they are not value traps, no? Okay. And then talking about the rotation to emerging markets. So did you know, for example, that last year, emerging market stocks actually outperformed the S&P 500, and they yielded a return of more than 30%. Okay. So S&P 500, you can see the total return is around more than 15%, but the MSCI emerging markets uh, you know, came out with a return of more than 30%. And I just want to highlight that it's not 100% about EPS growth, because you might say, well, the Philippines is so boring because the growth is only expected to be 7%. But remember, for example, for last year, valuations also play a significant role. One of the reasons why emerging market stocks outperformed the S&P 500 is because of the PE expansion. MSCI Emerging Market Index, for example, was trading also at the low end of the PE multiple. So when investors came in, they had a re-rating of the stock. So out of the 30% return, 21% actually came from the PE expansion. So these are the reasons for the outperformance of MSCI emerging markets last year. Um, they also benefited from AI and tech because there was strong demand for semiconductors. Um, so you also had Chinese companies that had AI and tech plays that rebounded in line with the US. Rising commodity prices such as gold benefited them. And of course, significantly cheaper valuations, which is something I'd like to highlight, and a weaker US dollar last year. So potentially this year, if EM continues to go up, Philippine stocks could benefit as investors look for value. Syempre, magiging mahal na rin ang ibang EM stocks if they continue to go up. Okay? Okay, so now let's talk about the different sectors. So we are saying maybe last year, I think things are looking better for the different sectors fundamentally. For example, for the banks, I think last year the two major concerns were, first is the net interest margins, and second is the provisions, no? Um, Okay, so let's talk about the margins first. So last year, people were worried that the margins of the banks would go down because interest rates were gonna fall. And yun na nga, the negative on the profits. But if you look here at the margins of the banks, so they started, for example, the third quarter of 2024, the margin was 4.25%. But instead of going down, you will notice that actually in the third quarter of 2025, the margins were higher. So concerns that the margins would go down because of lower interest rates are kind of overblown. And this is because of the banks benefiting from lower reserve requirements, faster decline in their funding costs, or yung mga time deposit rates natin bumababa. Pero the banks, if you borrow from them, you will notice that your borrowing rate is not going down as fast. And of course, they're also lending more to consumers, and the consumer loans are charged at a higher interest rate. So in 2026, earlier on, I talked about just potentially one more rate cut. So that should end further declines on interest rates, and should alleviate worries on the margins. Another worry that people have on the banks is provisions, because a lot of banks increase their provisions. But then again, the increase in provisions is not because of rising NPLs, okay, or non-performing loans. It's more because, first of all, diba, they're increasing their exposure to consumer loans, which are inherently more risky. And secondly, because in 2024, mababa yung provision. So ngayon, it's more of normalization. So here, for example, is a combined income statement. You can see, revenue line very healthy for the banks. The net interest income, which they get from lending and placements on mga treasuries, is up by 14%. The non-interest income, although it's down 8.8%, 6%, you can see a lot of the decline is because of trading gains, which are more volatile, but the fee income is still healthy, up 10%. So another reason, here's the provisions up by 27.7%. But I think for this year, the growth in provisions is expected to go down to only 7%. So that in a way kind of explains why net income was only up by around 6% for the third quarter. But for 2026, we're expecting net income of banks to increase more substantially. Anyway, for the property sector, um, there are indications that the worst could be over. I mean, it's not perfect, but at least the take-up sales, you can see na trending lower, di ba? There are signs of recovery. And this is due to lower interest rates and the popularity of ready for occupancy, lease to own schemes, and other promotions that property developers are doing to unload their excess inventory as far as residential is concerned. It's not perfect, but at least we're seeing signs of bottoming out. For the office lease rates, they're actually starting to recover already in most areas. I think you still have problematic areas like Alabang and the Bay Area, but a lot of the other areas like Makati, PGC, and even Ortigas and Quezon City, nagfa-flat na yung lease rates and going up. And then the mall leasing revenues are quite healthy. In the third quarter, the listed company showed a 7.6% increase in mall leasing revenues. And then the negatives are largely priced in. You can see that a lot of property companies are trading at very cheap valuations. 9.5 times average PE, 1.3 times average price to book. Okay, and then for the consumer sector, which is one of the worst performing sectors last year, one of the reasons why they did not perform well is because of rising commodity prices. Okay, but you can see, I think the trend has been going down. The prices have been going down, and this should help with the margins improving. For example, coconut oil, palm oil are actually down in the fourth quarter. Coffee is showing signs of going down as well, but this one, baka it might be delayed pa. So anyway, so here is a table of the sector opportunities and threats, and maybe um, you know, uh, in your leisure or later we can talk about it. You can see that there are some opportunities facing these sectors already. Okay, so for the stock picks, these are our stock picks for 2026. For those of you who follow my Calling the Shots report every month, actually, these have not changed much. Okay, for the last 2 months, the two new picks that I have during the last 2 months is Maynilad, because during the IPO, Maynilad was providing an attractive dividend yield, and of course, it's a defensive stock, and it has a lot of capex plans going forward. So, that's why we're quite bullish about this stock, no? And okay, what we expect to happen, of course, in 2026 is interest rates probably going to stay low, and that will make a lot of stocks with high dividend yields very attractive, which is why we're recommending, say, the REITs, power stocks, utilities, so they will benefit from that. And of course, being defensive, given the prevalence of uncertainty, these are your hedges, no? But that said, okay, so for the sectors that we expect to show bottoming out and are trading at very cheap valuations, we have the banks, properties. Our latest addition is DNL. Well, if you can see, the valuations really are very attractive. For example, on a fair value estimate, the upside is more than 100%. But it's currently trading at 8.6 times PE, which is really very cheap because DNL used to trade at 20 plus times, 30 times PE. And I think most importantly, 6.3% dividend yield. The reason why we picked DNL over other consumer stocks is one of the favorable trends we see as far as 2026 is concerned is the fall in commodity prices. So if you remember, I talked about oil and palm oil prices going down, and coconut oil and palm oil, and those two commodities account for around 60% of their raw material cost. So they will benefit the most from there. And if you look at what went wrong with DNL in 2025, it's not that their sales volume went down. Their sales volume actually went up. The problem really was rising commodity prices, which hit their margins, and also um, they had to borrow more money because, of course, as your raw material prices go up, your working capital needs also increase. So they had to borrow money, and their financing costs went up. So with the drop in oil prices or coconut oil, palm oil, they would enjoy better margins, and financing costs would also go down. So, plus, of course, they provide the dividend yield of 6.3%, which is really very attractive if you look at the other alternatives here. Okay, so that ends my presentation. So I'll join you again later for the Q&A session to answer any questions you may have. Thank you very much.
Thank you, April. Yeah, so if I may just share my key takeaways, no, from your slides. That's very comprehensive. But I guess for me, that I guess the takeaway is there's still a lot of uncertainties, but still also, I mean, valid reasons to stay invested in that it's not all bad. There's potential rotation, low interest rates, and more importantly, the negatives seem to be largely priced in given the valuations, no? And what resonated with me, so please say if this is accurate, no, boss. The You mentioned that how the dividends like seem to be providing a floor to the value of these investments, no? And if it's the case that earnings, doesn't turn out to be that bad, or the slow doesn't turn out to be that bad, or on the other extreme, if it picks up, if there's inflection point going up, then that could lead to further re-rating in the multiples that could lead to higher upside. So it is a correct, I guess, summary of your view, April?
Yes, that is correct. Yeah. So yeah, I mean, worst case scenario, you just collect the dividends. But best case scenario, the negatives that we're bracing ourselves for does not happen. And besides, if you look at the mix of the picks, we have a good mix of defensives, which should do fine regardless of what happens, and also some cyclicals that are showing some signs of bottoming out, no? Which could do better than what we expect.
All right. Okay, thank you again, April. And now we move on to the technical picture. To help us make sense of what the charts are telling us today, let us welcome COL's Chief Technical Analyst, Juanis Barredo.
Hello, good morning, Charles, and good morning to everyone. So let me get started with my side of the program. Okay. Guys, can I just check if my screen is showing?
Yes, we can see it.
Okay, so good morning to everybody again, and a happy new year to all. And so far it has been since we've managed to be able to see the market come to be able to resuscitate itself from the period of darkness we saw in 2025. And although we've seen quite a bit of a rally so far in the initial part of the year, just like we've seen in prior years, I just want to be able to caution everyone that I think we'll still be in a recovery mode, but we will still see some gyrations into the market. So I guess being a trader, I mean, I would welcome such volatility because it is the advent for where we can make good money. If markets remain flat, it's really very difficult to make money out of that. So I entitled my report as a seesaw recovery ahead, just to be able to take note that I feel that the worst is over, but the volatility will remain. And although, yes, it might be a little bit scary for some, for the people who are ready for it and prepared, I think it should present an opportunity where traders can actually make good money. All right. So let's begin first with the local market. And looking into the PSEI, you'll actually see a very uh, a healthy pullback since hitting that 5.7 to 5.5 zone that we came in towards November. And the market went up, consolidated, and continued to be able to move higher. So it's currently into a recovery channel, and I think we'll be coming closer to some resistance zones that I think we need to be watchful of. That would be a range between 6.420 to about 6.570. And if you can see in the chart I have here, I've outlined where those resistance points are. And the reason I'm also showing that is because if you were to look at your RSI below, we are hitting an overbought state already, and that would mean it could generate some volatility, similar to what you're seeing to something like this. So we just have to be prepared that things have to take one step at a time in terms of the recovery. We will have that recovery, but we will have it spread out towards the rest of the year. So I think what you'll see with the index is will probably come. I hope we can stretch out a little bit more to hit the targets I've outlined, and then come out and generate a pullback, of which we'll talk about in a while. Just be prepared for it. So if you guys are still buying issues, make sure that you're looking at issues that are beginning the run rather than streaking and showing extended advances, because those are more likely to be able to pull back with greater size. And I don't want you to get caught offhand after you see pullback such as that. Ideally, right now, the short-term support is between 6,100 and 60.30. That would be somewhere here where you see this red dot would be. And if we can see that and the market can try to recover again, maybe it'll come around to be able to hit these targets or maybe exceed it a little bit before another wider correction I'm looking at, which I'd like to talk about now. So looking into the longer term, part of what we do is we look for cycles into markets as well. And I took the opportunity to be able to look at how the PSEI managed to be able to swing off between 2020 and 2025. And one thing you'll probably notice over here, and I'll just identify this area here, which was a major top made in January. Again, another top made in January. The dates are different. I don't think you'll always have them on the same date. So roughly between mid-January to late January, and I've picked off some all the way up that sometimes can stretch off till about Feb. But I've seen major tops come out in those areas, or at least major turning points. Now, I'll identify them as a major turning point because sometimes the market heading towards that period could be heading downwards, similar to what happened here. If you notice, the market was falling down very sharply and generated a turning point just like it did during this period, but it did it as a low rather than as a top. How would you know which one it would be? Well, which way is the market heading right now towards that period? And as you can clearly see, we're heading upwards. So given this context, I would assume that in case these things attempt to repeat themselves, I'd be more likely to expect a top rather than making a solidified bottom between that January to Feb marker. Now, it's a temporary top. And the reason I want to call it out, though, if you can see in our history, we've seen quite a bit of turmoil and quite sizable pullbacks have taken place during these periods. And so it might be prudent for us to be able to prepare some lightening measures as we come closer to that, especially if your momentum signals attempt to be able to verify it. Like, let's say your MACD starts to turn, you're seeing extremely overbought conditions, you see prices are starting to break their 20 or 50-day moving average on the downside. These are telltale signs that more likely those turning points are coming to fruition. So what I want to do is to be able to prepare ourselves for that. First, I'm anticipating resistance here, then plus the turning point. So I would attempt to be able to make sure that as we come here, maybe I would lighten a little bit on some of the profits we've managed to make into the rebound. And then wait out for the next pullback, which would come. I try to be able to get a sense of normally how far down or in terms of time will the corrections take place. And again, I've seen bottoms made in June, July. There was one that went to June, rallied, that went all the way down to October, November, but it doesn't happen all the time. Another one, major low in June. So what I would do is I would anticipate that perhaps after a profit-taking session between January and Feb, to look for a new opening closer to that maybe June, July area, for the next major swing. So just those two alone, I mean, if you can protect yourself from the declines that would come from a correction and move yourself back into the next appropriate swing, I mean, I think that should be able to give your portfolio a bit of a boost into the profit side. So just for the traders out there, obviously, this would be the tactic you guys need to do. If you obviously are the longer term investor, you may ignore what I said. Just make sure that you understand it so that maybe for you, if you are under positioned and you come after a major correction, you can add to your position once the major turning points and the decline actually come around. So given that contact areas, so the first area, 6570, would be the major area to be able to break. Hopefully later down the road, when we see the next wave rally come in and you break the 6550, that should be able to open up the next pathway to next major resistance. And there's really not much in between. So if that 6570 can really be brought down durably, I think our next targets will really be somewhere closer to this high band of this large rectangular range that we're currently in. So just be very much conscious of this so that you can appropriately plan yourself off and just make sure that the first part we'll just be on our toes. Then on the next major swing we're in so that we can take advantage of the next big rally the market will give us. So let's go right into it. Another reason why I also feel quite optimistic is because if we were to look at the conditions of many of our index stocks today, you will notice in our tail of the tape graph here, you will see most of the issues have already pulled away from bearish trends, and most of them are either consolidating or some of them are already moving into bullish trends. Oh yes, there are some that are a little bit overbought, but that's okay. I'd rather it being overbought than going into a downtrend. And all this means is just we're waiting for timing issues and setups to appear before we move to be able to take the trade potentials that many of the stocks are. And we're talking about 28 of the 30 index stocks are there. So that gives me a positive flows that the breadth of the market clearly is on our favor. If you look at some of the other interesting stocks that many people have been actually trading, of course, a lot of the mining companies are not obviously into our index, so it's clearly not into an index lineup. But you would see a lot of other second line or even third line issues inside that have been doing quite well. And some of them are going through overbought conditions and may need to make a reaction. But again, they still remains into a bullish track. So again, with many of the names here, we're just looking for appropriate setups for appropriate entries. But I still feel that many of them may still have potential trade action coming towards this year. It will be very difficult for me to just pick off my top 2 or 3 stocks now because there are just so many. And I think market rotation will come in to keep things quite fluid. And so you're going to have to be able to do a lot of legwork here to be able to become a stock picker because you're going to see a lot of opportunities come around as the market goes to these 2 major turning points. And rotation will have its own way of telling you which one's ready and which ones are not. But keep many of the issues I have pointed out here under your radar for opportunities that you might be able to see. So to try to outline the potential swing action for the PSEI, I've attempted to draw out these 2 more optimistic scenario, the one in green compared to the blue one you see here, marked out in the time frames where I expect the turning points to be. So this would be that the January to Feb area and the lows being made closer to the June-July area. And so again, maybe do some lightening into these areas here. You don't have to empty everything, just lighten so that you have a little bit more cash to take advantage of corrections that may come in. I'm hoping, of course, the green scenario would come out so that it wouldn't give us too much of difficulty bearing with such reactions. And I just indicated the typical ABC swing here to make sure that there's appropriate correction time. And then after that, we'll resuscitate ourselves to try to go for the next gun for next resistance. So keep this in mind when you come around to be able to look for potential opportunities. All right, let's look at other considerations. And the other considerations are many of which are external. And the reason we have to be able to look outside is because we have to see what could impact our market, what could generate things that could make a lot of what we're thinking may happen not happen, right? So we start first with foreign markets, and as you very well know, the Philippines is not a leading indicator to global markets. We're normally a laggard to it, and we tend to follow what's happening. However, 2025 was quite disappointing because we didn't follow these markets at all. In fact, we went the opposite way. We went down. We don't do that all the time, but yes, we did go through a very difficult phase, especially when we had a lot of corruptive elements come and be very disruptive to the trend effects. But I think a lot of that has been priced in, maybe not completely all of it, but I think a majority has been priced in. And so I agree with what April said earlier. And coming from a major low into a market, I'm hoping that we can be more sensitizing to what other markets are doing as well. So as long as these markets like the S&P, which just last night made into a new high, the German DAX broke out of a big consolidation pattern also recently. You're looking at the Shanghai market in the upper right, also breaking into a new high recently. Japan now testing the highs that it hit, but it did break out of this triangular range. So there could be potential for this to be able to make a continued recovery above. All these are telling you that they're supportive of sentiment, and I'm hoping to be able to capitalize on this. So the only thing that will go against us is if we start seeing many of these top out and make head downwards for major corrections. By the way, I did check some seasonality for the S&P 500 as well. And although, yes, there were also some periods where between February and March, particularly in March, we do see some corrections begin. But many times they don't come down as long or as wide as the way we saw into the Philippines. So I wouldn't put heavy impact on that. The long-term trend of the S&P is still very much up. Even if this S&P were to fall all the way back down here, that's still fine, and it would not change the long-term advance that we've been seeing in many of these markets. So I'm still quite optimistic in what this can do. But yes, there could be corrective efforts in them because they are a bit extended as well. Now, another thing we look at will be bond yields, and these are because these are precursors for interest rates. And I guess what I'm really watchful of right now in particular is the US 10-year bond yield, because it's currently consolidating at a resistance point. And last night it tried to break out, but fortunately it managed to shove itself back in. On the short-term 2-year bond yield rate, it did rally from the bottom. And so I guess the only time we'll feel pressure here if we do actually see a breakout or a sustained breakout coming above the 4.1 percentage point area, that would be a bit concerning, because that would mean that not only would it mean that perhaps the rate view in the US slow down, or that the cutting rates may slow down, but maybe you might not get too many. And this is the reason why you're seeing that the yields are attempting to move up. Now, yields going up generally are not liked by markets, and that adds a little bit more bearish sentiment to that. So if this moves up, and particularly the Philippine yields you see here on the right side attempts to be able to follow that, then that might cause a little bit of a ruckus with markets. Maybe a hiccup, but maybe not so much. I don't think the upside will be tremendous, but you're coming from the point of view where we're looking at wider number of rate cuts, and all of a sudden towards the end of the year in 2025 we said not so many, and this year we're saying maybe only one. And so that will attempt to allow yields maybe pull up and then turn flattish, but maybe not so much down anymore. And I guess markets will have to be able to price that in depending on what revelations our central banks give us. In terms of currencies, I would still be a bit more cautious about the peso, because right now the peso is here flirting with major resistance at about 59.20. And in recent days, we've seen the dollar index climb up from this low, and seeing this happen could put added pressure into the peso. And if we do break over 59.20, then there's a potential for us to slide back to about 60.20 as the next target, as you can see this channel range present itself. Again, if that happens, I'm sure markets might feel a bit queasy about that because they may not know up to where. But I think that the rally in the dollar will be limited, because if you notice, major resistance is still standing here. Even if this were to rally up to here or here, you still have this blocking it. So I don't think you'll probably get a push out very, very suddenly above that. And I hope that that would limit whatever potential depreciation we would see into the peso dollar rate. If you're looking for other markets, you can clearly see that the currency that's been doing really well, obviously, has been the Chinese yuan. You can see how the direction is very much on the opposite streak. It's gaining so much strength, in fact, even accelerated. And that continues to be able to keep that trend effect quite strong. And I think that will continue to keep China a little bit of a boost, despite even the dollar attempting to make a little bit of a rally. So I guess that's something to take account, especially for those people who are looking for other markets to be able to trade. And then April did point out about the weakness into the yen. Now, people kept on asking me this question earlier on because they were saying they heard that the Japanese were raising interest rates, and they haven't done that for a very long time. As they're doing that, why is the yen still relatively weak? Well, the reason is because the difference between the rates between the yen and the dollar still are quite wide, giving you negative real returns if you were to be able to just invest into the yen. And given the context that it's likely that you probably won't get too much of rate cuts into the dollar unless something more substantial is raised into the yen, that differential would exist and still give you a negative real rate of return. And that's the reason why people are still relatively bearish into the yen until maybe one day we see rates attempt to recover into something shows that a smaller disparity between the two. Now, well, these will affect us. It's really more of the dollar that will do so. So I'm keeping more attention on this. But movement over here and this one may cause some gyrations with other global markets, especially those who are cross-invested into other multi-assets across different parts of the world. Then commodities. Okay, this is how we've had a very good story in 2025. This year, I think we may have to deal with some overstretched conditions from some commodities, and that might force some parking. And we've seen that metals have been very strong. Gold was very, very strong. Even nickel just recently broke out of a major consolidation, shooting upwards. Then silver has been also quite strong. In fact, percentage-wise, even stronger than gold. And I don't see these trends changing, although perhaps the trajectory may slow to handle some corrections. That would mean maybe some pattern making in the interim. But like I said, I don't see trends changing. I think you just need to fix the exaggeratedness or the overbought conditions, and prices may still be able to see some lift from there. Opposite to that, though, we have oil. Oil prices have been into a downtrend. It has consolidated recently, and I think it's been trying to be able to play a watchful game because we've been seeing some geopolitical risks because of what the mechanism we've been seeing between the US and Venezuela, of course, the issues between Russia and Ukraine. And of course, oil plays a very big part into that. But we haven't seen any breakouts from the downtrend yet. Until I do so, I would just follow this trend until something more substantial comes out. So right now, I'm not looking at this as a major threat. I think even if this were to break out, it'll be temporary and it'll come back in to generate a higher low base. So just to be able to sum up on actionable things we can do. So my probable scenario is that we're going to continue the wide range we've seen between 5.7 and 7.560, but we're not going to hit this target right away. I think you might see that in the latter portion of the year as a possibility. But the first target range will be this 6.560 zone. Thereafter, you might see the market do go through a turning point for a correction and a pullback. We have to be prepared so we can move to take advantage after that pullback ends in line for maybe a second year or the second half of the year rally. Into this, my strategy would be range trading mostly for many of those that follow the index pattern. That means you're buying from the low end and trying to trim your positions near the resistance bands. For those that are trending strongly, I think issues, for example, like ICTS have been very, very strong. Even at Manila Water, Maynilad. We've got quite a number of issues also attempting to fix themselves recently. Pullbacks that come closer to the uptrend line or to your 20 and 50-day moving averages might be good areas for you to be able to nourish buybacks. And that should just protect you from seeing too much short-term volatility. And then, of course, keep watching for strength because I think what's moved ahead of time will move again after corrections. So write these names of these favorite issues now. And when you see the markets resuscitate them after corrections, I think you might want to be able to jump back into them. But also, please also take note, liquidity is very important. So don't just buy any issues that moves. Qualify that the issues are being participated upon and that relatively healthy amount of volume is coming into that. Because you don't want to get stuck into a correction with stocks that don't trade very well, because that would just extend the volatility downwards. Now, in terms of the sectors that we have for banks, I think you will see a cascading recovery. So that means draw a channel upwards, a wide one, and then you will see the ups and downs of that swing. That's why I called it a seesaw. Under the services, we may have to be very selective. I mean, issues like ICTS are clearly a standout, isolated case, but still very strong. I would keep that under my radar into pullbacks. Then the utilities, from water companies to broadband companies, many of these are mixed. Obviously, the water companies have moved ahead. Some other utilities like Meralco has done relatively well. British Power has done well. You have now the broadbands issues trying to break out of consolidations. We're keeping an eye on them right now. So you will see the ability for the market to rotate from one to another. And that's a reason why I don't want to just extend one or two issues to highlight for you. You're going to have many opportunities to look for rotational issues into 2026. Consumers, I think you will also see a slow recovery, and you may also have to be a little bit selective, but maybe not so much as the services. Property, you will also see cascading recoveries just like the banks, but I think it might be a little slower. If you were to just look at three property stocks like Ayala Land, SM Prime, and Robinson's Land, there's a very far cry difference between the three, right? So you're really going to have to know which ones are which and what could be the reason that one is underperforming as compared to the other, right? I mean, you might want to be able to text your favorite fundamental analyst to tell you the difference between Ayala Land and the Robinsons and how come they're so very much diverse. Then REITs. I think REITs will still do okay right now, since I think interest rates will be generally stable. Maybe REITs might also be a bit more stable, but buy these on pullbacks rather than any attempt to be able to rally, right? Because you want to get a lower price to be able to show higher yields for yourself. So don't be too much of on the hurry to be able to buy REITs. Wait for them to buy a buy window when they react to major moving averages. Then miners, I think you'll still have activity, but just keep in mind that some of them are a bit stretched. So you want to wait for these to be able to make some reactions between your purchase conditions. And so what could affect our view? Well, the view is, let's say, for example, the rally we're looking at fails to rally over the 646560. That would mean that I may have to be able to account for a weaker recovery situation on the index. But if it does go above that, then everything should be able to fall in as expected. Second is, what happens in the surprising condition that the market falls back below 5.7? I'm not looking at this scenario, but just in case it happens, that would clearly be an undercut to everything, because you're literally pulling the rug off our feet. And we may have to make an adjustment downwards for the potential for this market. But right now, I have yet to even come or bring this under my expectation. I'm just writing down what could affect our view. And lastly, the peso. I mean, a break over that 59.20, or worse, if it were to break over 60.20, that would get me really worried. But right now, the 59.20, yes, I'm building that, the potential break here, but at a maximum level of about 60.20 being the level, also because I explained to you that the dollar at that particular zone might be also encountering major resistance. On the external side, of course, a rally and extended dollar, not good for us. Global equity breakdown, that means strong markets we've been seeing are starting to break below their 50-day moving average. That clearly will shake many markets. Any continuing movement from bond yields or inflation threat might be a problem. And of course, an end to the commodity uptrend clearly will affect the miners that we have today. So I guess these are the things that we will keep into our trade book just to be able to outline some potential risk. so that just in case we do see some of them, that we may have to be able to pare down on the heaviness of the positions we're taking in the local scene. Okay, that brings me to the end of my presentation today. Charles, I'll leave it up to you. Let's go to the Q&A segment.
Yeah, thank you, Sir Juanis, for your presentation. So it seems like the worst is over. A lot of the stocks are showing signs of a strong, healthy rebound. But at the same time, equally important, you mentioned also that volatility is expected to remain. So I believe that's the main, I guess, message that we have to remain, disciplined when it comes to our trading. All right.
That's
So
right.
thank you, sir. So for the next segment, let me invite April back to join Juan. And this next part is usually the most popular and exciting part, no? So as usual, so we'll be going through each of the 10 most requested stocks that came from you guys. And we'll be asking our experts whether they like a stock or not by raising their paddles. Okay, and of course, we'll also ask them to explain their rationale so we may learn not just their current views, but also better understand their framework, their investing framework as well. All right, so let's go to our first company. This is the most requested stock, no? So by in order of the request, I guess. First one is Jollibee. So speakers, is it a thumbs up or thumbs down? Okay, both thumbs up. All right, so could you quickly share your views, your rationale? April, you want to go first?
Okay, so I think the major news came out early this week about the spin-off of the foreign operations. I think that will be very positive. I was just looking at like even before this, I was just curious kasi kung isipin mo, I mean, Jollibee is so much more profitable today than it was 10 years ago, and yet the market cap is actually lower. Um, and one of the things that to be excited long term about is the foreign operations, because in the past they didn't know the right formula, but now, the foreign operations is showing some, traction. And yet the market doesn't seem to be appreciating that. So if they spin it off, then maybe it's going to be easier to analyze Jollibee, which is of course more positive. Of course, for the viewers today, um, abangan ang susunod na kabanata, because next week they will be briefing pa, and a lot, the devil will be in the details, like how will they do this spin-off. Maybe that's why it's a 2027 story pa, di ba, the spin-off. It won't happen in 2026, but definitely I think it will be good it will be favorable for investors, and it will help unlock the value.
So it's all about unlocking the value, no?
Yeah.
Sir Juan, is on your end, what are you seeing in the charts?
Okay. First of all, Charles, if I may just explain, because I think a lot of people were getting a little confused that what would happen if, let's say, April would give a thumbs up and I would give a thumbs down, or vice versa. Please understand we're looking at this view in two contexts. One is the fundamental aspect of it, which is we're talking about its earnings, its growth story, is everything intact, valuation. Whereas technicals talk about roughly timing, entry point, trends. And so if we differ, it could be if April likes it and I may not, it's just purely a timing issue, right? In other words, if prices set up again and they break off, I mean, it could be something worthwhile watching. It doesn't necessarily mean that you can take your eye off it, right? It could just be a timing problem, or vice versa. If I show you something that looks good technically and it's bad fundamentally, well, it could be short term. It might rally, and then later, because the fundamentals will catch up to the price and may drag the price down. Which is, let's say, something. Remember, I think happened last year with the Plus, something like that. So, right. So just keep in mind that we have to understand both points of view and how to factor in. But anyway, going back to Jollibee, I agree. I gave a green thumbs here because I think it looks like the avenue of the worst end is over. I could see an accumulating situation take place here before the breakout, and I think that over in time, this will attempt to be able to wrestle itself up. However, I think what bothers me is the 2027 target because that means you still have 1 year to wait before materiality comes out. And I think that's kind of a long time. So you might have room for this to consolidate. So maybe, I don't know if we can expect it to just rush up automatically. And like April said, the devil is in the details. You still have to wait for that to come out. So expect more volatility, but I think you'll probably see more consolidation time for Jollibee. But I'm still looking for it to move a little bit higher, not to go back to its low.
All right, that's clear. Uh, Thank you for that, sir. Can we go to the next stock? Ayala Land. Okay. Uh, Thumbs up, thumbs down. What do we think? Okay, also both up. All right. April, do you want to share your view?
Okay, so for Ayala Land, well, I think, compared to, or anyway, if you study the performance of Ayala Land in the past, at least during times of falling interest rates, the share price actually rallies. Tapos, di ba, binibentahan. But this time around, even with the expectation of falling interest rates, the share price didn't rally. And the reason for that is because if you look at this chart, no, tingnan mo, coincidental, it happened around September, and it came about because of the flood control scandal and crackdown on corruption. Remember, Ayala Land always talks about being strong in the premium segment. And of course, you hear all these stories about corrupt government officials buying all these expensive condominiums, etc. So I think that really hurt the sentiment for Ayala Land. But again, earlier on, we talked about how negatives are priced in. And we feel that for Ayala Land, that is the case. The negatives are largely priced in because at the current valuation, Ayala Land is only valuing the rental properties. But outside of that, let's say let's remove the premium properties, the super expensive condominiums. We're seeing some pickup already in the middle income segment. The take-ups are improving because of the lease to own ready for occupancy units and promotions, etc. So yun, baka sobra lang naging negative ng mga tao. So, I mean, I think eventually people will forget about this, and if the other segments of Ayala Land continue to improve, then I think the share price will go up.
Okay, thank you. Juanis?
Mhm. Well, it's still in a recovery trend and coming off the low. And again, I don't anticipate that Ayala Land will go back there. However, there could be another opportunity if this corrects to be able to find a higher low base and to make another entry, especially if Ayala Land were to follow those two turning points I suggested earlier. So I wouldn't be as aggressive to maybe some of the other stocks in terms of doing this. I think cascading movements will likely be the case for Ayala Land. But again, like I agree with April, you buy this into the next pullback, and there could be more materiality to its advances on the second rally that it would make. Maybe not necessarily in this round, but I'm still quite optimistic for potential buyback here.
So if I may just ask a follow-up, sir, no. So because Ayala Land now, it seems like it's like having a hard time, no, struggling with the current level, no. So for those who are able to, the traders, no, the short-term traders who are able to buy at a lower price, is it a good time to take some profits and maybe wait for a pullback? Is this the one that you're mentioning a while ago?
Uh, Sometimes it's hard to tell the pullback until certain signals are done. Right now, it's still trading above the short-term averages, like 22. So unless 22 is broken, it would be hard for me to tell you that the major correction is beginning. It has to break through that area before I see it. Because there could still be the chance for it to rally back to 24 before that reaction takes place. So I don't want to be too hasty.
Okay, got it, got it. Okay, let's go to the next company. Metrobank. Thumbs up or thumbs down? Both thumbs up pa rin. Okay, good. April?
Yeah, so in general, banks have a better growth outlook this year. And of course, Metrobank will benefit from that. And I think what's special about Metrobank is it's expected to pay out huge cash dividends. So I think the dividend yield of Metrobank is around 7%. So that should actually, make it more attractive for investors. In a way, I mean, if you look at how it performed in 2025, it actually didn't go down a lot. I think it's because of the huge cash dividends that they pay out.
So is the dividend sustainable in your view?
Yeah, it is. So to determine whether the dividend is sustainable, you look at the capital adequacy. And Metrobank's capital adequacy remains quite healthy, and uh, loan growth is not expected to be running away naman. I mean, it's growing, but not, like super fast to the point that, they have to preserve their capital and uh, keep from paying out the cash dividends.
Yeah, so so Metrobank is, just for context, it gives out one of the higher dividends relative to the other banks, especially the bigger banks. From the technical side, Sir Juanis.
Well, it's encountering some resistance now at 71, but I haven't seen it really back off that way. So I still think there's room for it to be able to recover closer to 74, 74.50. So I'd be on the option to hang on to this. And if we do get the opportunity to get the pullback closer to next support, right now that's currently between 68 and 66. Look for buybacks there if you can take your profit into the upper bands of the range. So I'm still fine with this. It looks like it's really trying to bottom out, if not already.
Yeah. Okay. Next company, AREIT. Okay, so what do you think? Thumbs up and
Oops, sorry there.
it's okay. Thumbs up. Okay, okay. All right, all right. I seems like there's a trend, no? It's all green so far. Okay, April.
Yeah, so this is one of the favorite reads. So before I said I was kind of worried because it's parang wala nang kwento. It's already part of the index. But then, upon closer review, I just realized that AREIT has a plan to inject around 20 billion pesos worth of assets every year. And if you look at all the REITs, actually, AREIT has the best track record of increasing its dividend per share. So in other words, all the injections have so far been dividend accretive. Okay. So yun, quite positive because we're also expecting more asset injections this year. Ayala Land has a lot of rental assets that they can still inject into AREIT.
So every time there's an asset injection, we expect it to be incrementally, dividend yield
Okay.
accretive. Correct.
Yes, for AREIT at least, that has always
Mm.
been their objective, and they have so far achieved that.
All right. Sir Juanis?
Okay, so being a REIT, I've stated earlier that I think more of a pause in the movement rather than a momentum streak into this, and in particular on this particular one because it's been consolidating for quite some time. However, I don't want to be able to give any sell conditions here because the objective over here is if this price moves to a lower end, you're supposed to look for potential entries, right, to make the yield more viable. And as long as I don't see any major uptrend reversals, and to me, that supports between 41 or 40.15, unless those are broken, any pullback here, you can continue to be able to buy it. And I think potentially the appreciation should be able to add on to whatever dividend yield you get. And the next major resistance after 45.20 will be closer to 47.90. So buy this into your dips.
Okay, so as I have a quick question for the REITs now, because the next couple of stocks are also REITs, no? Because it seems like a lot of people, because REITs did very well the last couple of years, I think a lot of our clients are holding on to, significant gains.
Hmm.
I guess the question is, what would you say, when they're asking that, is it time for them to take profits, to maybe rotate to other issues, or to wait, to sell some to be able to buy it when it comes back? So what can you say with that, with those long-term investors that are up significantly on their REIT positions? What's your advice to them? April,
For
you
me
want to take it
ba?
first?
Yeah, okay. I guess as long as interest rates are expected to continue going down, um, I think they can still hold on to it. And maybe also look at the yield. If say the yield of the REIT is down quite significantly, or sabihin natin, let's say maybe it goes to the 4% level, maybe you should take profits first and buy it back when it goes down. Kasi syempre, I mean, okay, for REITs, for example, because what it pays you is dividends. It's taxed at 10%. Pero let's say you're looking at bonds. Maraming mga bonds ini-issue ngayon. Ang dividends or the coupons are taxed at 20%, which may be one of the reasons why, di ba minsan magtataka ka, why are the yields on REITs lower compared to bonds?
A
It
little bit
might
lower,
have,
like around 5
yeah.
for the lowest one, around 5+%, right? Wala pa
Yeah.
naman nagpo-4 for the REITs.
So I think it has to do with that, the income tax differential. But anyway, if the yields go down, or the dividend yield goes down to maybe below 5, then you should think about maybe taking profits first and then shifting it maybe to other REITs, for now. But at least the interest rate outlook is still favorable for REITs.
Okay. So hold more or less, but just watch out for the yield. No. Okay. Can we go to the next one? RCR. Thumbs up, thumbs down. Thumbs up pa rin. Both. Okay. April.
Okay, I think yun na nga, the RCR kasi, well, yun na nga, they had this major asset injection that happened last year, which explains the huge increase. And then right now, one of the benefits that they have is that they're now predominantly a mall leasing, a mall REIT, no? I mean, hindi naman 100%, but heavily tilted to malls, which is in a way kind of more defensive, which benefits them. And then more asset injections are expected this year. And then aside from that, I guess people are positioning for the potential inclusion in the index because of the increase in market cap. So, ang ano ko lang, my only concern about RCR is medyo mukhang priced in na because I think if you look at the yield comparison, RCR has the lowest yield. But again, it's still above 5%. So maybe if this one goes up substantially, it would be a good opportunity to maybe take profits. Maybe if it's included in the index and the price goes up a lot, then siguro take profits as move muna sa ibang REITs.
All right, that's very clear. Juanis?
Yeah, well, again, positive on the note that it's going through this streak, and I'd like maybe you can use this as a good demonstration. Like if you're coming off to what happened between August to October, and then you get those corrections into the REIT like the way you see, and it corrected to the 200-day, the green line at closer to 705. This is exactly what you want to do whenever you see a correction into the REIT market, particularly those names that are popular. So, for example, if you get corrections that can come back down to either the 100 or 200-day moving average again, then that should be the entry point for this. The reason that it's consolidating now is, like April said, you just had a huge move from 705 to 8 for a REIT market. That's kind of very big already, right? So you're getting that profit take maneuver. So look for opportunities for pullbacks into support before you buy this. But again, it still looks decent to me. I don't see any reason why we shouldn't look for added windows to buy this into corrections.
Okay, thank you, sir. Let's go to the next one. CREIT. Okay, thumbs up or thumbs down? Thumbs up for both. Okay, April?
Yeah, okay. So this year I think our CREIT will be getting the asset injections from CREC. So that will help the dividends go up a lot, and that will be favorable. Yun lang siguro investors might have been a little bit disappointed because the details are not yet out, maybe a little bit of impatience. But aside from that also, CREIT is also more defensive. Kasi no matter what you say, it's power and then they only have one tenant, di ba? So mas defensive siya. So those are the factors that are favorable for CREIT.
Sir Juanis, it seems like it's closer to the support, unlike the other REITs. So is it a good time to buy? And what are your thoughts?
Yeah, well, actually, I was thinking myself, why is it pulling back so clearly as against the other REITs, right? I guess April explained the reason why people may have been disappointed. But I think the pullback should be an opportunity as long as the major moving average does not break. And I put that threshold of about 340, 346 as major support. So as long as we don't break that pullback, so you can look to buy. If it just happens to break over 360, 361, you can add into your position. Because if this turns out to be a wedge, then we just have to be very attentive into that. April, would you happen to have an idea when that injection could take place?
Um, I don't know yet but sige, we'll interview them to find out more details. But okay, just want to tell everyone the reason why I'm quite confident that it will happen. It just might be delayed because if you try to, if you know the background of CREC and then the long-term plans, uh, CREIT is instrumental in CREC actually raising capital. So they need CREIT to in a way buy the asset, no? Once operational na yung plants ng CREC, CREIT needs to buy it so that CREC has more capital so that they can reach their 5 gigawatt target. So CREC has a very aggressive growth target and they need all the capital, which is why they have no choice or hindi naman no choice, but they have a very strong
Incentivized,
incentive to
yeah.
actually
Right.
it's injected into CREIT.
Okay, thank you. Very clear. Next stock, please. PLDT. Is it a thumbs up or a thumbs down? Will we get our first thumbs down? Thumbs up pa rin, both. Okay. You want to go ahead?
Okay, so for PLDT, well, kung earnings lang or top line, it's a bit boring, di ba? Parang it's just, sideways, minsan slightly down or up slightly. Not much going on there. I think if you look at the performance in November, I think the catalyst was that the company talked about being free cash flow positive. Baka magtaka kayo, so what does that mean? So, a lot of people buy PLDT for the cash dividends, and right now it has a dividend yield of 7%. So around November, the dividend yield was around 9% na yata eh. So when it says they're finally free cash flow positive, it means that they don't have to do a lot more capital expenditures and then that they have a lot of cash. So that means that, yung ability nila to pay out the cash dividends is actually, a lot more, a lot better. Okay? And aside from that, well, medyo pero the earnings growth might come not from the top line, but actually from lower financing cost. Because what will they do from all the free cash flow that they get? Aside from paying out cash dividends, they are going to focus on paying down the debts.
All right.
So, yon. So, lower interest expense and stronger capacity to continue paying out the cash dividends.
All right. Thank you. Sir Juanis?
Okay. Well, into the short term, it looks like there was an attempt yesterday to try to break free from that little consolidation, and I hope we can see some continuations. MACD looks good enough to try to help propel that into the advance. The reason I think it's been having a hard time is because the last rally brought it to the previous high, which is closer to 1,333, and it's now encountering some little bit of distribution there. And I think it needs to do a little bit more to push upwards to tell us that it wants to be able to continue higher. But it seems that there's enough support that's been holding it. And so I would hold a position here. Maybe I can take a little bit more as an extra chance and put a major stop at 1,240. and keep our fingers crossed that we'll break through that 1,300 level to be able to put more added incentives so we can rally to where it came from, close to 1.4.
Okay, next stock, please. AC Ayala Corporation. Thumbs up, thumbs down. Okay, we have our first thumbs down from April. Could you explain your rationale why?
Okay, so when I say I don't like it, doesn't really mean that I really don't like it. It's more of if you make me choose.
Okay.
Kasi parang the issue with Ayala Corp recently is if you think about why you want to buy it, wala kang masabi aside from that it's cheap.
Mm,
Okay.
mm.
Kasi yun na nga, all the major subsidiaries are listed. And they're all trading at cheap valuations anyway. So, yun, wala lang compelling reason to buy Ayala Corp. But, that said, I do realize that as the other stocks go up, that investors could rotate into Ayala Corp. And then, di ba, earlier on, I talked about, some flows going to the Philippines. I think that, of course, they will also buy Ayala Corp because it's a large cap stock and it's trading at very cheap valuations. So yun lang compared to the others. Probably last priority, it's more like a rotation play type of thing.
All right. Thank you, April. Sir Juanis?
Okay, I'll take it for what it shows itself, not in comparison with others, because if I were to have done that with other issues, I probably would have developed so many other reds. But taking it on its own, it's into a rally channel. It looks kind of in the same stage that we saw Ayala Land was on. Most of the subsidiaries, like was pointed out, we have recoveries in BPI, Globe, Ayala Land. So, and we still feel that there could be added recovery there. And I guess that should be able to add to the value and help this push. But again, it's going to be more of a cascading flow for this. Major resistance is at 520 and then 546. So you got a lot of resistance way ups. You want to buy these always into pullbacks closer to support rather than try to think this is a breakout. It's not a breakout. This is just a resistance break, which is different. A breakout is you're pushing out of a pattern or you're pushing out of a downtrend. And right now we're seeing a continuation swing and you're coming closer to resistance. So maybe if you're looking for an entry, wait for a little bit of a pullback. If you currently have it, you hold and you put a stop at 450.
All right. Very clear. Thank you, sir. Next stock, please. I think the last two. Next stock, please. Oh, BDO. Thumbs up or thumbs down? Okay, we're back. Okay. Two thumbs up. Okay. April?
Okay, so same as Metrobank, it should benefit from this year, at least it's quite clear na the margins aren't going to go down. And of course, provisions are normalizing. So maybe faster net income growth, better sentiment for banks. And yun na nga, after going down a lot last year, valuations are more attractive already for BDO.
Okay. Sir Juan?
Also the same as Metrobank. It also rallied now at major resistance and now pulled back a little bit. So give it some time to breathe. But a higher low made for BDO will be your next position for an entry. And I think on the next rally swing, you probably see much more viable upside because it really had to wrench itself through a lot of these resistance zones. So higher low is what we want first for next major entry, and then you probably see more viable events. Hold for now with a stop closer at 128.
Okay, thank you. And our last stock, SEC. Thumbs up or down? Okay. Okay, our second thumbs down. April, go ahead.
Well, it's more of for me, it's more of a risk management lang because in the first quarter, we will know whether the coal mining operation will be allowed to continue. Okay? alam naman natin, for example, I mean, usually you think, that's nothing, it will be allowed to continue. But, well, of course, we know what happened to ABS-CBN. The franchise was not renewed, no? So you do have that risk, no? I'm just a little bit worried that if, for example, the coal mining operations will not be allowed to continue, that would have a significant impact on their P&L. So coal mining accounts for 75% of Semirara's profits. But aside from that, remember it's a vertically integrated power generation company, and it uses its own coal. So if the coal mining operations does not continue, then it will have to buy coal outside, and that would have also an impact on the power generation, which is 25% of the profit. So significant impact. Aside from that, I think one of the reasons why Semirara is very, I think, popular is because of the huge cash dividends that it pays. But if the coal mining operations does not continue, that dividends will also be negatively affected. So more of that cautious side. But when I asked George about this, he said most likely naman it will be continued, but maybe the government will ask for more royalties. There's also that possibility.
Okay. Okay, Sir Juanis?
Okay, so right now it looks like it's established a higher low base and it's rallied back to the high band of the channel. So I guess the short term there could be a potential resistance problem here closer to 31, but ideally major resistance will be closer to 32 because that's also where the breakdown took place. And I guess with what April just said, you might maybe want to lighten first and then just buy back na lang when prices pull back rather than think that a push above this will be a breakout and you'll see a sustainable advance. Given I think what she said and an underlying risk, we just have to be able to make sure we watch our risk levels here.
Okay, thank you. Thank you very much for your views. For our audience, please do note that their views don't guarantee future results. I see a lot of greens, but again, it's not a guarantee. Our goal is just to help inform you guys on what we're seeing today and to better understand the thought process of our experts. Okay, so now let's move on to our Q&A segment. So I see that it's 11:36 now. So I'll request our speakers to give concise answers because I see a lot of questions, unfortunately, or fortunately or unfortunately, I guess. So yeah, so let's go to the first advanced question. Yeah. Can we go to the advanced questions? I believe the first 4 questions reflect some of the biggest concerns that our clients have now. So just some quick thoughts on this. First one, how will the ongoing corruption investigations affect the market in 2026? From Mark and 4 others. April, you want to start?
Yeah. Okay. So I think it will cause increased volatility. For example, the market is doing well right now, but there's a risk, for example, that the fourth quarter GDP will be weak again because of the ongoing corruption investigations or anything. The government is not gonna spend, di ba? So yun, pag pangit yung GDP, lumabas yung news, baka bentahan yung stocks, di ba? So yun lang. There could be increased volatility, but then again, there are factors that could counter them. So hard to be too bearish. And yun na nga, the negatives are priced in.
Yeah. Okay, very clear. Sir Juanis, anything to add on that?
No, it's fine.
Okay, second question, please. How much will we be affected by the US intervention in Venezuela? From James and 5 others. Will we be affected, April?
No, potentially it could be positive because, for example, if oil prices go down because of that, then it should be good because remember, Venezuela actually has, well, a lot of oil reserves. They don't really have a lot of oil production right now. But, potentially that could be what will happen and it will allow them to produce more oil. And that could lead to lower oil prices, which is beneficial for the Philippines.
Sir Juanis, are the oil charts reflecting this, like the better likelihood of oil prices going down?
I think that was the reason why it was trying to consolidate at the base. But since in the end we saw that things were quickly, let's just say, resolved, it doesn't seem that we'll see too much pressure come off that because it looks like that the US might try to be able to keep that supply issue under their control.
Okay, thank you, sir. Next question, please. How will the AI boom and potential bubble in the US affect Philippine stocks? From Matthew and one other.
Well, kasi the concern is, of course, if there, we don't know if it's going to continue, ha? Kasi, I mean, anything's possible at this point, diba? If, assuming though that these AI stocks are sold down, the AI bubble pops, unfortunately, yun na nga, we will be affected negatively kasi nga, kung bumaba naman yung market, di pati tayo kasama.
Is it fair to say ba, April, that if ever that happens, that like worst case scenario happens, that the decline in the Philippine market, given our valuations, won't be as bad or won't be as sharp? Is that fair expectation?
Well, that is my hope. Kasi, I mean, 'di ba? Parang ano pa ibebenta nila?
Yeah, at
'Di
GFC
ba?
levels
Parang
na, no, the valuation.
yeah. If you look at, for example, the net foreign selling, we've been suffering from net foreign selling for so many years already naman eh.
Yeah.
'Di ba? So that's the thing eh. Uh, Meron pa ba silang maibebenta? Yun na lang ang
Okay.
tanong, 'di ba?
All right. Sir Juanis, what are we seeing from the charts? Does it seem like the US is under any pressure, or even the specific AI names?
Recently, there have been more volatility into the AI stocks, but there's still a number of tech stocks that still are looking okay. But if you notice in the last activity, the Nasdaq was down compared to the Dow. So it does seem like some of them seem to be taking some profits into some of these AI related issues. But I have not seen anything substantial to cause a reversal. So I'm not really, I haven't really seen the potential bubble explode there. I'm more worried about what AI integration to businesses may do by driving cutbacks into uh, employees across the world, of which it could hurt us because of the BPO industry we have, and that could lay out on properties. But that's looking a little bit down the road.
All right. Okay. Next question, please. Okay, How will the market be impacted if the dollar breaks above 60 pesos? From Ritz, Kevin, and three others. April, go
Well,
ahead.
historically, a weaker peso has been bad for the stock market kasi syempre mga foreigners, um, 'di ba? They will have forex loss. So if that happens, they try to avoid in general, foreign markets like the Philippines and even other EMs.
Sir Juanis, anything to add?
Yeah, so I think generally um, if you have especially a strong dollar causing weakness in the peso, you will get people that might affect foreign flows inside us, and that's the reason why, of course, it can generate some negative sentiment into our area. So I find it difficult to believe that it'd be positive, right? So clearly more negative than it is positive. That if that scenario were to happen.
Okay, thank you. Next question. Okay, so for this next one, I believe throughout your presentation you gave a lot, no? But if you could highlight maybe one or two, like the biggest reason for investors to stay optimistic for the Philippine market, despite the current negative investor sentiment, from Joel. April?
Okay, so for me, one of the biggest reasons, would be the high cash dividend yield. Okay, low interest rates plus high cash dividend yields. And by the way, compared to before, I remember, for example, during the GFC and even during the Asian financial crisis, at that time, if you really think about it, talagang there were real issues about corporates. Like they had a lot of debts, then business turned bad. Pwede silang mabankrupt, may ganung risk, bankruptcy risk. But if you consider the situation today, yes, we have problems. But the economy is still growing, companies are very strong, they don't have a lot of debts. Unfortunately nga, walang expansion. But anong ibig sabihin nun na wala kang expansion? You have a lot of cash. Which is why they're paying out a lot of cash dividends. And we're, na there's this unlocking of value that we enjoy by buying them cheap and then enjoying these cash dividends.
Yeah.
So for me, yun na lang. If I don't need the money anyway, I might as well just collect these cash dividends because my alternative is, let's say, go to bonds, go to the bank and get deposits. Wala. Mas mababa naman makukuha
Yeah.
ko eh.
Actually,
Diba?
I did I checked, no, from your calling the shots picks. The average dividend yield is 5.2%, no, the one that you gave just a while ago. So
Yeah.
for our clients out there who's happy, 5.2% is not bad, right? As an average, no. And then, as you mentioned, there's upside potential, but if things turn out to be
Yeah.
not that bad, right? So
Yeah.
I think that's a very good flow.
Oo. Yeah. And also remember, 'di ba I showed the chart where I showed the 10-year earnings. It's not negative naman, it's still
Yes.
growing. And as
Yes.
the profits grow, the dividends also increase. And
Yes.
secondly, if let's say you don't need the dividends naman, the income that comes out of the dividends, then you can reinvest it and then do compounding. For example, 'di ba yung isang uso nga na market is say Chinese market. The compounded annual return ng China market is actually mga 7% lang eh. So, if you actually get your mga 5% and compound it, you could also double your money after 15 years, which isn't bad, 'di ba? So, if you just look at the index, parang walang nangyayari. But if you do like a dividend reinvestment kind of investment framework, and then as long as the companies don't become bankrupt naman, then you have a chance of still doubling your money.
Okay, thank you. Sir Juanis, biggest reason for optimism for technicians like you or traders?
Well, the opportunity I'm seeing really is because we're coming from a major low and the potential for it to recover back to hopefully a mid or high level band can project something, and that would be a range of about 4% to the high band would give us maybe a 15% return if it goes back to that area. So there is some potential in being part of the emerging markets. I mean, that's why people buy emerging markets for such high returns. But let's just make sure that we tell our customers that Philippines is not the only market there is here. You got to compare them with what they get from others. China alone, the index there did more than 25% last year. Plus, their currency is even gaining ground. So why wouldn't I consider other markets? So yes, you can look at the Philippines. You can look to be able to get a segment of your opportunities there, but keep on a scout on what other opportunities you have around you. But 2025 is a sad story for the Philippines, and we're coming out of that big rat hole, and there is potential upside, and that's the best reason I can give for a potential participation back for now. But you don't have to put everything in here.
Okay, so I'll do one more advanced question. Let's go to the next one, and then we'll go to the live after. What catalyst could turn the PH market into a bull market from Eugene and two others? April, anything that you're seeing, Juanes?
Catalyst.
Uh, that's a good question.
Yeah.
No, I think
I
if I may, it might need some time, right? I don't think we see the catalysts around the corner. You got to be able to plug in a lot of holes just yet, and we're coming from recovery. And since you're coming out from a bearish phase, sentiment is against us, right? And there has to be a proof that would come out that can show the Philippines in different light, and that still has to be put out front and center. Right now, it's just the a reversion to a mean of our valuations because we're coming from an extremely low point. April?
Yeah. Well, I guess I don't know what the likelihood is, but yun na nga, earlier on, I talked about the finance secretary saying that they're gonna have government spending actually ramp up in the first quarter. So I mean, people aren't counting on that, but what if it does happen? And I mean, think about it, no? If you do the math, ano lang naman yan, let's say your GDP is growing faster, but let's say if your government spending is actually going to corruption, wala siyang multiplier effect, or if ever it does, it's minimal. But what if, let's say, for example, government spending this year is up 7%, but it's all 100% legitimate government spending that goes to the people to improve productivity, to improve infrastructure, and, may multiplier effect. Then that's actually very positive, 'di ba? Baka yung longer term growth picture ng country is actually better. So, I mean, people aren't counting on that if you think about it, given our valuations. But if that happens, then we will see the re-rating of the Philippines, no? Yun lang naman. And also, let's not focus on the top down. If you look at the bottom up, there are opportunities. Last week I talked about it in the weekly. When you look at 2025, syempre, if you look at the index, pangit. Pero if you look at individual issues, you did have a lot of issues that went up. For example, for the mining stocks, you had commodity prices going up like gold, copper, and all of that. So you had a lot of mining stocks going up. Then, of course, as interest rates went down, the REITs all went up. So yun, marami namang mga sector or company-specific catalysts. So you could do more active investing.
So there's definitely opportunities. Okay, can we go to the live questions? Okay, given the focus on globalizing portfolios, what is the ideal allocation percentage for global versus local Philippine equities for moderate risk investor in 2026 from Marvin?
Am I
April?
supposed to answer that? Actually, if you think about it from a from a CFA perspective, dapat naman talaga the focus really should be US centric because of the size of the market capitalization, no? And alam naman natin yung tinuturo, buy index stocks. But that said, for me, my main worry about following that allocation per se right now is that the US market is very expensive right now. So if you start with that allocation na, let's say you're Philippines, lugi ka. So, tapos ngayon ka pa mag 100% US, or sabihin natin 80-90% US at a time where it's expensive. I mean, I'm not saying it won't continue to go up, but there is a greater risk that it won't, and your starting point is mahal siya, di ba? Yun lang naman ang worry ko. But ideally, kung yun na nga, from a CFA perspective, you should be allocating like bulk of the portfolio in the US.
Okay, Sir Juanis, anything to add?
Well, I know it's a difficult question to answer, but I ask myself, if I were to split my portfolio into 70 or 30%, where one would be global and one would be local, I think from the point of view is I probably would have been in the 70-30, where 70% would be more global than 30% local. After the market's been recovering, I don't know if I would even dare invert that. I would maintain my allocations because the other market seems to still be continuing upwards and I haven't seen a top. So it doesn't look like there's any need to pare that down.
Okay, okay. Let's go to the next question. We all know the PSB has been pretty quiet and mostly moving sideways compared to other markets around the world. For small or retail investors, it makes you wonder, what are our real options for diversifying outside the Philippines? No? So similar thought, no? April, Juanis? April, you go first.
Yeah. For me naman, I do encourage diversifying outside of the Philippines, and there are alternatives nga through buying funds
Fun.
that are now available to Filipinos. We have a lot of funds. Hindi ko lang kabisado yung exact funds, but I think we have mga recommendations on which funds to buy and where they're heavily invested in. Pero yun lang nga, don't be too negative naman on the Philippines.
Yeah, yeah, the message, Don't be too negative. Sir Juanis, anything to add?
Yeah, well, I guess adding to what April said, I mean, the funds availability from our side are very much wider now than they were several years ago. So by buying funds now, you can have exposure either to the US or a combination of different parts of the world. You can have funds that are looking for bond yields. You can also have funds that are looking for potential tech plays. So there's a lot. I mean, I think this you might consider yourself a small retail investor, but you can buy these funds for as little as what, one to 5,000 pesos already. So I mean they're very much open to you. So please explore, and we have funds that you can take in, even though you are retail investors. It's precisely for you that we generated these particular availability.
Okay, maybe we can take last two questions from our live. I'm sorry, we are just we don't want to go past the 12 o'clock mark, no? So, can we get, given the volatility in the market, what are your ideal parameters to be used as
Oops.
indicators to monitor the trend as a template for maximizing buying and selling, from Alex?
Okay, maybe I can take
Sir
that.
Juanis?
So if you're short term, normally I use the 50-day moving average as a threshold point to tell me whether markets are still available into the upside, or if they break below that, then that means you're looking into the correctiveness of the market to come in. So I'll be using that when we come to this next turning point as a potential. I don't want to put too many indicators. If I do that, if I put too many indicators, you're probably not going to know which one to follow. So maybe just a simple trend line or a moving average can help you make an assessment into that for the meantime. If you want, you can help the MACD if it does cross down, and that tells you momentum is slowing. So if your momentum is slowing and your moving average is breaking, that should be a good enough signal for you to tell you that it's time for you to lighten up, wait for the next opportunity for a buyback, because we're going to a corrective phase. So use that first.
Okay. And then for the last questions from our live audience, top 5 stocks to buy if you are in for dividends. Okay, and willing to hold for a year or two. So maybe just a couple, April, dividend stocks that you like. Or should they just look at your picks?
Yeah, my stock picks, marami naman akong cash dividends, no?
Yeah, the average is
Yeah,
5%.
yeah.
So I think they can just pick from the list.
But I guess for lower volatility, mas defensive tayo. Maynilad, Maynilad AP, and then the REITs.
Yeah.
Yun.
Okay.
More of that. Okay. And by the way, there's one stock na high dividend na hindi ko na-highlight na REIT that might be attractive for this year. MREIT. I think it's a 7% dividend yield. They'll also be injecting mga assets. I think maybe the pessimism has to do with the fact that they're more heavily invested in offices. And so far, the injections are not dividend accretive. But if your risk appetite is a bit higher, that's a 7% dividend yield stock.
Okay. Okay, thank you very much. No, so unfortunately, that is all the time that we have for a Q&A. Thank you, April and Juanis. No, so before I let you go, I ask for your final thoughts, and maybe what would be the biggest or the most important advice that you could give investors and traders for at least the first half of 2026. April, you want to go ahead?
Well, yeah, I think Charles, you did a good summary and key takeaway already when you talked about it. So there will be a lot of, I guess, I feel that the market could be very volatile, but there are a lot of opportunities, and I think for investors who are saying Philippines is a value trap, it's not a value trap. And then we're seeing some improvements on a bottom-up perspective. So there really are opportunities. So I guess focus more on the opportunities rather than the noise when buying Philippine stocks.
Well said. Honest?
Well, again, taking for that volatility, I think that the highlight will be on selectivity. Don't expect that everything you buy might move, so you have to be a stock picker. and just raise some of the issues that I wrote down into my report to be able to filter off a lot of the noise, and just make sure that you're buying issues that have good liquidity, that are have traded in the past and had showed activity already, and hopefully that a lot of what April managed to point out to the positives are included into such stock, so that you can have a reason for this to continue higher. Um, but again, also keep track of the two turning points I'm talking about this year, right? One maybe nearby, and so that might be an opportunity to do some lightening and for a potential buyback maybe towards mid-year. That should be able to give us good windows to be able to reap the benefits of some better profits than 2025.
All right. Thank you again to our experts today, April and Juanis. Thank you for your time.
Thank you as well,
Okay.
Charles. And thank you
So
to our
Yeah, thank you,
viewers.
Charles.
yeah. So before we formally conclude, let me try to wrap it up quickly by giving my biggest takeaways. No. So I guess I could just pull up the slide very, very quickly. First one is that the volatility is the new normal, no, as our chairman likes to say, no. So always continue to manage your risks, right? So April talked about all the headwinds the Philippines might still be facing, right? And then Sir Juanis also talked about how there could, given the overbought conditions recently, there could be an upcoming, turning point wherein we could get in at a better price. No? So be wary of those risks, right? Continue to manage risks. It's not, the market's not going to run away, right? But at the same time, when you're choosing stocks or when and what to buy, you have to stay disciplined and you have to be deliberate, right? So if you're a trader, know your setups, buy closer to support, don't chase prices. If you want to rely more on fundamentals, no, so look at the earnings, the dividend yield. There's a lot of bottom-up stories that we discussed today and that April highlighted that she likes. No? So we have, in this environment, we have to be very disciplined and very deliberate in our investing process, given on who you are. No? And then last, which I think is probably the most important takeaway today, no, is that opportunities remain even in the Philippine market. I know it's might be hard to believe for some. Investor sentiment is quite low, but as we've seen, there's a lot of green shoots, a lot of positive signs, and whatever the case may be, there's your dividends to serve as your floor. And if the worst case scenario doesn't materialize, maybe we could finally get some capital appreciation. So as our chairman often likes to say, I have never seen a rich pessimist, no? So let's not be too bearish, right? So a quick plug before I end. No? So for those of you who like to get more frequent updates from our speakers today, you can follow April. April's Calling the Shots report, which she releases monthly by going through our research tab. Of course, everybody knows by now, she also has her show, so we can follow that as well. For the technical side, you can hear more from Juanis' view by checking out his tech spotlight, which is published daily. So with that, we hope that this session has been helpful. Wishing all of you a great 2026, and thank you for watching, and see you in the next one.